The other day, I was walking around Avon getting ready to go to Best Buy. And to go to Best Buy, you have to pass a Bed Bath & Beyond. And I noticed that the sign said store closing and they were having a liquidation sale. A couple of days later, I saw a headline that Bed Bath & Beyond had contacted a bankruptcy attorney firm. One of the most important things you can do as an investor is simply not make bad mistakes. And the worst mistake you could make is buying a business that ultimately goes bankrupt. In a bankruptcy proceeding, you may get something out of the business, but most likely you'll end up getting nothing. So what are the signs of a business that is dying and ultimately heading for bankruptcy? In this video, we're going to look at the anatomy of a dying business using Bed Bath & Beyond as a case study.
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
The first sign is the stock price is absolutely collapsing. It's important to remember that the market is made up of millions of very smart, highly motivated participants. Just because a stock is down 50% doesn't necessarily mean it's 50% cheaper. It may be that the business itself has eroded 50% or maybe even more, and that price decline is justified. So seeing a major price decline like we see here starting in 2014, 2015 is not at all a good sign. Basically, this entire move lower suggests that the market believes there is something seriously wrong with Bed Bath & Beyond, and sure enough, that was the case. The number 6 warning sign are capital allocation changes. Capital allocation is simply what the business does with the leftover money. So let's say it's making a huge profit, and it can do basically 3 things with that. You can either reinvest back into the business for more, hopefully, future growth. 2, it can return cash to shareholders in the form of dividends and buybacks. Or 3, it can pay down its debt. Any major changes in capital allocation can be a signal that something has changed with the business. Bed Bath & Beyond initiated a dividend back in 2016. So this is the price chart above, and then here is the dividend yield. They initiated a dividend in 2016, and while you may think that is ultimately a good thing, in this case, the dividend turned out to be a bad sign. Number 5 is no sales growth. Sales are the lifeblood of any business. You can't make money without making sales first. So when you see a stagnating sales picture, it's time to consider whether the business itself is having some major fundamental issues. This top chart is the price per share, and this chart represents the year-over-year sales growth. Sales growth fell significantly back in the recession of 2008 and 9, but it never actually fell below 0. Then there was a period of strong sales growth from 2010 through 2014, but then the problems really started. Sales growth hovered around 0% for the better part of 5 years. And then in 2019, sales growth started to deteriorate. Basically, sales have shrunk ever since then. And now sales growth is negative 26.37. Another warning sign is stagnant earnings. In this chart, we have earnings per share. And after several years of earnings growth, earnings really started to flatten out from 2014 to 2017 and then head significantly lower ever since then. They're actually losing money starting in 2019, and they really haven't recovered. Bed Bath & Beyond is now losing $15 per share. Another variation of earnings is owner's earnings. Owner's earnings are what Warren Buffett calculates. This is his preferred method of assessing a business. And basically, he's getting at what would the dividend be if this company paid out all of their earnings as a dividend while keeping just enough to keep the business earning the same amount of money without reinvesting for future growth. If you're interested in how to calculate owner's earnings, I cover this in my Valuation e-course. I'll put a link in the description below for how you can get 50% off of the price. But if it's something that you really want to take and you can't afford it, just send me an email. I'd be glad to work with you on that. I have a subscription to Portfolio 123 and I calculate this automatically. So I did that for Bed Bath & Beyond. Owner's earnings started flattening out about the same time actual earnings did, and they have absolutely collapsed, also negative, although a little less troubling at negative 13 instead of negative 15, but still a very negative picture here. Number 2 is the interest coverage ratio falls below 1. Interest coverage is the amount of times the company's earnings can cover its interest expense. So we simply take the earnings, or actually EBIT is what number we use. That's operating income before interest and taxes, divided by the interest expense that they show on the income statement. So if we look first at the interest expense over the last 12 months, you can see that starting in 2014, interest expenses went from about $5 billion per year all the way up to about $80 billion per year. This would have been a big sign that something bad is happening, really starting in 2015. And if that wasn't enough, you can see that the operating income over the last 12 months started falling off a cliff in 2014 and 15. So if you combine higher interest expense and lower operating income, interest coverage ratio goes from an extremely healthy 400, meaning the earnings are 400 times higher than the interest expense, and now that is now below 1, meaning that the interest expense for Bed Bath & Beyond is now greater than their operating income. And the number one way to tell if a business is deteriorating is a deteriorating return on invested capital. For those of you who have followed my channel for very long, you know that I'm a huge fan of return on invested capital. I think this is the single best metric for assessing whether a business has a competitive advantage or not. The idea of this metric is if you would reinvest $1 back into the business, how much additional money could they make? So putting $1 back in the business and them earning another 50 cents on the dollar is extremely good. Something like Apple would have a return on capital that high. And if you look at other businesses that aren't so good, like for example Ford, you'll see return on invested capital has historically been 5% or lower, which is the sign of a very bad business. But it can also be useful to not just look at the absolute level of return on invested capital, but to look at the changes in that metric. And returns on invested capital started to shrink back in 2014, and they really collapsed all the way through 2020 before slightly improving in 2021, but they have since fallen back into negative territory. So even though Bed Bath & Beyond had a relatively high return on invested capital in the 20% plus range, the clear deterioration would be a very severe warning sign that something significant was changing. So what should you do if you have a business in your portfolio that has some of these signs? I think it's okay if you see maybe 1 or 2, but if you start to see a pattern where multiple of these signals are starting to move against you, it could be a very clear sign that either something bad is happening with the business environment as a whole, or something may be starting to go wrong at that particular business, something you should seriously consider looking into further and considering taking action if what you find is not to your liking. Thanks to everyone who is currently supporting me on Patreon. I'll have a monthly Q&A video coming out soon, so if you have a question you'd like to ask, you can go ahead and post that and I will answer it in the upcoming video. Also, thank you to everyone who has purchased my valuation course. I'll be adding some more content in 2023, so if you're interested, you can get signed up using the coupon code in the description below to get 50% off. Thank you for watching, and I will see you in the next video.